welcome everybody. Last week we had the first of a series of 3 webinars where we had Charles Golding as a guest, and we kind of looked at recent developments and RICS guidance. This week I thought it would be really interesting to look at how DCF, we think of the use of discounted cash flows in terms of appraisals of investment value, investment worth, but then also discounted cash flows in the use of red book valuations, and that's today. I thought the focus is primarily on red book valuations, how they're being used, how widespread, and so on. So it's lovely to have Matthew here today, and I think I won't really drill down into my profile because I feel like I'm repeating myself every time. And Sonia has kindly given some insight there in terms of what I do. So if I just, Matthew, would you mind just jumping in? It feels a bit strange me talking through your profile. Can you talk us through your career path to date and the sort of work you do, if you don't mind?
Yeah, sure, David. Thank you for having us. Thank you for inviting me on. Happy to introduce myself. I actually came into the industry potentially at the worst time ever, just 6 months before the GFC kicked off. I was I wanted to be a pilot, and then I thought, no, now's not a great time to become a pilot. What else do I like? I like buildings and things like this. So, how do I go and become a surveyor? And I found myself a job in London after I came out of university, and they put me through the distance learning masters from the College of Estate Management when it was linked with Reading. And so I qualified with them, having done my masters and sat my APC and qualified in 2012, before I went to Dubai actually, and I got some overseas experience because, just personally, I'd always wanted to live and work abroad for a time. So I went to UAE. I was covering asset valuations in the Middle East and over in North Africa as well. Did that for 3 years before coming back to London. I was always going to come back to the UK, and I found myself a job this time with Knight Frank in London doing institutional investment valuations. So this is portfolio work for funds, for REITs, for insurance companies who are holding diversified portfolios, and for unit pricing reasons. And so every month, every quarter, every 6 months, I have various clients who I report to, such as Aberdeen, AW, L&G, M&G, Swiss Life, and we're valuing the portfolio as a whole, but we're valuing each property across the UK individually. And I've been doing this for almost a decade now, and this topic is one of the big topics of the moment. It's how we see it moving from a traditional valuation approach to utilizing a DCF approach. And
Great.
yeah,
Yeah. No, and I will kind of, I think we'll tease that whole idea out of the notion of how DCF sits with traditional and what is happening in the marketplace. I think it's really interesting to note. I didn't realize that you had come into the market around the global financial crisis time. That is actually probably weirdly enough, a really good starting point in any career to know how bad a market can actually get. And that was an exceptionally bad time in the marketplace. So as not to forget those bad times when we're doing our work and how things can change, rather than being in a bubble. It reminds me of when I was a surveyor in the 90s and early 2000s in Dublin, and that there didn't seem to be any end to the rising market there. Of course, the GFC put an end to that as it happened. So yeah, thank you very much. Interesting also, I didn't realize you were planning to be a pilot. So now you're working with DCF. That's really interesting to hear. So thank you, Matthew, for that. Looking at, we talk about the Red Book, RICS guidance on valuations. It does have some relevant key definitions that we should look at here today. Again, sorry, Matthew, could I ask you for your thoughts here. If we start, there's three definitions here. Could you talk us through how they relate and how they're used, why they're important, and what do they mean?
Yeah, absolutely. We undertake valuations for a variety of reasons. Um, Unless they fall within one of the exceptions, they all must be a red book valuation, which means they're under the RECS professional standards, which are updated periodically. Um, so market value, first one, the market value is only at the measurement date. So the date of valuation is a snapshot on that date with the information to hand. And this takes into account market-wide inputs and assumptions, and it also excludes special value. The other one you've got there, investment value, is the value to a particular owner, and that is given that particular owner's particular circumstances, and that can include special value, such as marriage value. Like if you own the unit next door, you can get some sort of economic benefit of owning two things side by side. Other things as well, it's personal costs of capital, personal fee structures, and all of these things make it a calculation of worth because it is individual to that investor rather than being reasonable for any market participant. And then market rent, that is also a basis of value. That's got a very similar definition in the Red Book to market value. This is, a willing purchaser, a willing seller, and in market rent, it's a willing lessor and a willing lessee at the date after a proper marketing period, acting knowledgeably, prudently, and without compulsion. Now, market rent is the correct term. Estimated rental value isn't a base of value, but it is used interchangeably with market rent. The RICS asked people to stop using ERV, estimated rental value, a couple of years ago, but it's still out there in the market.
Yeah, I forgot myself in that sense, Matthew. I still reference it myself in modeling that I share with my students. So I may need to give that some further thought. So yeah, thank you. Great. Well, thank you for your thoughts there. Moving on, then, there are we talk about the traditional valuation method and then the discounted cash flow method. Could you take us through how they differ and why is it so significant that they are different? And also your thoughts, I think, about how valuers are maybe what their attitude is to DCF, knowing that there is this traditional method. Are we seeing more greater use of DCF at the moment, or do you think there's some challenges? I have a slide that will follow this that I took from last week, which again looks at the challenges, but your thoughts on that would be really helpful. Thank you.
No problem. I think maybe just to start with, it's the question of why evaluation. And it's really because for best practice, you want someone outside of the investment manager who is providing that third party look without being connected, having no conflict of interest as to what the value is, what the market would pay for it. So unlike in the stock market, property is not frequently traded and access to information can be limited. Property can be worth more to one investor than another because of the way that individuals assess the relevant information and the expected rate of return. And having conflicting views like that is why we have a property market anyway. You need two parties to make a transaction. So buyers and sellers bid against each other until an agreed price is reached, both parties having their own view. And then the final price will represent the relative strength of the buyer and the seller, as well as the interpretation of the information. So in a bear market or a bull market, so in a bull market, it's a seller's market, and in a bear market, it's really a buyer's market. So we are taking those transactions in order to put a price on the property which isn't being transacted, and so we're doing that on the investment basis rather than selling houses or flats, which would be on a comparable basis. But we are using comparable transactions data in order to apply similar metrics to the properties that we're valuing. Now, the traditional method, the most common method, is the equivalent yield, which comprises capitalizing the current income under the lease and then the value of the market rent in perpetuity, obviously deferred until lease expiry. So the equivalent yield itself, you can think of it as a single weighted average yield, which is applied to both the term and the reversion. Now, today's rent is set by the lease, and during the lease, you might have rent reviews, which would potentially increase the rent, or you have a lease expiry, at which point market rent can be captured. That's the full market rent. And then the equivalent yield is applying the same capitalization rate to both elements of that, and added together, you come up with the property valuation. Now, just very briefly, you are using today's market rental value for the property, despite the fact you're not going to capture that for a number of years until lease expiry. Therefore, the yield, we say the yield is growth implicit, and we come on to implicit versus explicit. The DCF is an explicit method. So in a well-functioning market with transactions to rely on, the valuer will come to an opinion of market value, which will tend to be within a few percent of the true value. Because we're using comparables, it's often accused of being backwards looking, because it doesn't forecast rental growth, for example. But in fact, all valuations are forward-looking, because what price would you pay today in order to receive future incomes? So those future incomes are discounted back to present value today, even on the traditional method. So fundamentally, the traditional method does rely on the concept of discounting. Query is whether a more explicit and more sophisticated model comes up with a better valuation. Ultimately, the answer should be the same. We're comparing it to initial yields paid, to capital values per square foot paid on transactions, and every valuation has a stand back and look, does that look sensible? Does that look reasonable in this market? So the maths, the algebra, the arithmetic is all there to write it out by hand, or to write it out in Excel. There's a couple of software packages available to the valuer. One is Argus Enterprise, another is called Kel, and another MRI. And these are user interfaces, really. These are to make the job of the valuer easy by having a screen where you can put in the leases of each tenant on a multi-let, and the rents and market rents, etc., and apply your capitalization rates. Now, what this enables us to do also is make the traditional model more explicit as well. We have the ability to factor in voids in the future, rent freeze in the future, fees in the future. But again, things come back to today's market rents. That is the difference. That's the big difference.
I think also, sorry,
yes,
Matthew, no, I beg your pardon. I think from the whole kind of fund management or decision-making process, let's say, where I think the real value, and perhaps that's where the interest is coming from, the real value is if you look at a typical holding period of 10 years, and you look back on the decision-making process, arguably the explicitness of DCF has the edge then on the traditional. The valuers are being employed because of their knowledge and expertise of the markets and the technique they're using. That's fine, but the DCF it may well come up, as you say, with the approximate same figure at the end of the day. But I guess looking back, I think it has been a difficulty for particularly with investors who aren't necessarily from the real estate world, and they look at, well, the traditional method. How did you adopt? What was your logic in using certain yields in the process, and how were you factoring in risk and so on? That was more implicit. So yeah, it's interesting how we're comparing them. But sorry, I interrupt. Just one further kind of are you seeing widespread use of DCF in the work that you and your colleagues are doing in Knight Frank? And I should also say, if I hold that question for a moment, just to thank, if I take a moment, while these are your own views, nevertheless, Knight Frank have been very kind in their support of the webinar today. So I would just like to take the opportunity to thank Knight Frank. But sorry, Matthew, going back to the question about how commonplace are the use of DCF, are you seeing a change in the market and in terms of how they're used in real estate?
You're absolutely right, David. The investment management community making investment decisions, they're building diversified portfolios based on capital market models of what is a good diversified portfolio to try and get out specific risk and just leaving systematic risk. So we come across people in our clients. They're not surveyors, they're not valuers. A lot of them are financial professionals who like you say, see that equivalent yield and don't really understand it. They say, how does this one yield reflect all the risks in the market?
Mm-hmm.
Show me the growth. Where's the risk-free rate? What's this? What's the letting up risk? What's the tenant risk? How does the tenant credit impact your view on this, that, and the other? And so we're seeing investment decisions made on a DCF basis, and we are seeing traditional valuations, being prevalent. But the topic at the moment is moving the traditional over to the DCF. And to answer your first question, DCF is widespread used in operational assets already, in hotels, data centers, build to rent, self-storage. These elements where you have differing annual rental incomes or net operating incomes. So you have a top line revenue, you have various costs coming off, leaving you with a bottom line EBITDA. Whereas on a traditional lease model, you have an FRI lease where the tenant pays the rent, and then there's a service charge, and there's not so much that the landlord has to account for, and which is why the traditional method is quite a simple method of capitalizing the rent. Right? Also, on those operational assets, you tend to find, well, you do find that you're targeting a stabilized income at a certain point after 3 years, 4 years, 5 years, which is then grown maybe at 2% per annum thereafter. Whereas in a multi-let or an office or in an industrial estate, you have tenants going from one lease to another lease to another lease. So you do have a bottom line income, but it's very much fixed for each of those leases while they're in effect.
Mm. You've just actually touched on something that has kind of lit a light bulb in my head. You referred to the fact that DCF is perhaps more embedded in operational type assets, which the ones you've suggested. I was involved in a research paper with the IPF some years ago where we talked about alternative investments, alternative type. Now that expression alternative means different things to different people, but essentially we were looking at hotels, build to rent, and different kind of more if I put it this way, less traditional, less mainstream, like office, industrial, retail. And so therefore, and investors were very focused on those alternative, and I'm using that expression just to work with alternative the alternative sector because of they were seen as niche, but they were attractive because they were generating higher returns at the time in comparison to the more traditional type. So it's interesting. Perhaps this uh, further interest in DCF is coming about because fund managers and other investors are looking at these alternative forms of investment that have DCF already, and they're seeing the benefits of that and wanting to apply it to the more traditional type sectors, let's say within property. So a really interesting thought. By the way, we have a good turnout here today, which is lovely to see. If there's anybody with questions, please do use the chat box at any point. Jump in as I mentioned. There's a couple of people here I recognize. I see a colleague here as well. Hi, David. But if you guys, as you would with my normal kind of tutorials or lectures, jump in at any point with questions. I'm very happy to look at that. And if there's any expressions that we're using, I heard EBITDA, anything of that nature that you're unsure about, do ask us for clarification. We're happy to answer that. So yeah, thank you, Matthew, for that. The final two sentences here on the slide: best practice is to adopt the accepted approach in the marketplace and then review or sense check using other methods. So you're trying to triangulate between if it's traditional method, term and reversion is the accepted approach. There's still a place to use DCF as a cross check, a sense check, to see how the figures all lie and how they sit. Does it make logical sense in terms of the modeling that we're doing? The increased number of input variables within DCF is a double-edged thing. It's its greatest strength, but equally it comes with the challenge because those variables in the assumed traditional methods were not so key in terms of having to express particular positions on those variables. We'll touch on that later. Time permitting, I have a very simple Excel investment worth and market value and how they compare to each other. I'll need to open that, but we'll try and get to that in a moment. So again, thank you, Matthew, for your thoughts there. This is the slide that Charles and I looked at last week, and I thought it has a certain relevance here because Matthew is from the marketplace at the coalface with the valuations that he does. So I did wonder whether was I getting the points correct in terms of the attitude to DCF. So fear of change amongst certain valuers who are used to using. So why perhaps there's a perception among some, why fix something that ain't broke? Perhaps there's a bit of that. Inconsistency of use of DCF in terms of modeling. The levels of sophistication that is out there varies massively. Lack of transparency on risk, we touched on that in terms of comparing traditional with a DCF. But even with the use of DCF, there's perhaps not enough discussion about risk and the position the valuer is taking with the DCF model. Future rental growth not explicitly factored in. DCF model of appraisal or valuation differs from the traditional as it adopts the market's assessment of future rental growth in an explicit way. This future income stream is then discounted back, which Matthew talked about, bringing it back to today's value. The traditional method only uses today's rental values and discounts the income at a rate based on analysis of comparable transactions. Yeah, maybe. So I'd be interested in Matthew's thoughts. The use of tools connected with the DCF, this to stress test scenarios, sensitivity, probability are three that I can think of. How widely are they used with DCF? Is there a concern about how to use them? Confusion between even that, maybe I wouldn't think the confusion between IV and market value is widespread. Certainly not in the world of red book valuations. You would know it, but perhaps for non-real estate investors, let's say, they struggle sometimes to differentiate. And then lack, I think that last one, not to, this isn't a list in terms of priority, but the last one, lack of supporting data in terms of key variables like rental growth. And there I go using ERV, my bad. Rental growth and yield growth can be difficult to source. And that perhaps Matthew and I were chatting about this on Monday, this particular point. The idea of how we generate that data. If you're an independent valuer, how do you source that information in comparison to the larger firms like JLL, CBRE, Knight Frank, Savills, Cushman's? Are we seeing as DCF becomes more widespread? How are all valuers going to be able to adopt it? Is that going to be a challenge? Had you any particular thoughts, Matthew, on those points being raised? Would you agree with them? Do you disagree with any particular points being raised here?
I don't think there needs to be a fear of change.
Mm-hmm.
You know, our clients on the investment side are using DCF to make the decision. We need to understand as a valuer why they're making the decision they're making. We have global money looking at the UK. We have, pan-European funds, Americans coming in with, and they don't understand the English way of valuing. They are comparing it against other asset classes, and it gives them greater clarity and interpretations of rates of return and yields, and therefore how property sits. Um, so the benefit is to them rather than the valuer, but it's not, doesn't need to be a fear of change for the valuer. It is different. But as leases become shorter, UK leases used to be 25 years long with upwards only rent reviews. That has become 10 years. Now it's very standard to have a 10-year lease break at 5. So so as soon as you've got a lease in place, as a valuer, especially valuers doing it quarterly or yearly, you start thinking about the explicit risks sooner than ever. So if you build in a void and rent free on, in the second year, you could do it on day one and just have them periodically repeating over the 10-year hold period.
Mm-hmm.
It's just there in your valuation model.
Great. Okay.
Consistency, well, a good Excel sheet. We've seen investment decision being made with a lot of work tabs in Excel. These are complicated models that have been built outside of Argus. Argus is just a tool that we have as a valuation tool. Excel is capable to handle these decisions. So even things like discounting annually in arrears versus quarterly in advance. Rent in the UK is normally paid quarterly in advance. And if you agree with a tenant that they can pay monthly in advance, that will have an impact. Just the time value of money means that has an impact. It's easy to do in Argus. It's probably a bit harder to do in Excel to write the formula properly for that tenant's income to be, a 12th monthly in advance rather than a quarter at a time. And then we, as a house, we have a research department. Other houses do as well, and we also buy in research. So we cover the UK rental growth in all sectors for all geographies across the UK through our own research and through research that we buy in as well.
I think it's probably worth. Forgive me, I'm mindful of time, and we could talk about this all day. I think we're talking about a sort of level of sophistication coming with DCF, but at the end of the day, we shouldn't lose sight of the fact that there are different types of investors out there. There's long-term, low-risk type investors, but there's all that are kind of one end of the spectrum of risk. There's also always going to be people who are speculators, entrepreneurial, and go on instinct. You may well come across that from time to time. I know you do a lot of fund work, but more individuals, so they may not necessarily rely so heavily on it. But it's still for the wider market. This level of sophistication is a positive thing, I think, to see. There is a question here from Gareth. Thank you, Gareth. Thanks for the insights. Does the level of adoption of DCF in valuations vary by location and market, i.e., UK versus Europe? That's a really nice question. Had you any thoughts, Matthew, on that?
It's typical in Europe. European valuations are mainly done on a DCF basis. Um, Apart from those sectors I mentioned earlier, sort of operational direct let, um, we are slowly moving as our clients require it. It's If you go back to your question over whether it should be mandatory or by choice, um, I think it's true that it depends on what the market is doing. We valuers don't set the market. We just value according to what we see in the market. We follow the market, and we're guided by what the market does. And it is better in some circumstances than others. More necessary. So I'm a fan of it. It's sort of building on being explicit in what we do. There are questions.
Great. So
Internally.
it's horses for courses. It's what's appropriate for the local market. It will vary across Europe in terms of what's expected. I'm going to move on. I'm mindful of time. I'm going to, Sonia, if I could, if I'm going to look to try and set up the Excel sheet. Forgive me if I'm a bit clunky with this. I hope you can now see the Excel spreadsheet. This is a fictitious sort of scenario. The property doesn't exist, Phoenix House, and Gazprom are not the tenant. So I should just point that out. It was something I shared with students that we were kind of toying with figures. So you have the tenancy schedule at the beginning, but I thought what was useful here is just to share there is a date. Again, ignore the date for the moment. Share some of the key variables. I've highlighted in yellow some of them. The ERV is, where is it? There it is, over there. And then the proposed purchase price. This is an investment worth approach where the investor is considering, should they buy it at 125 million, assuming certain key variables like hurdle rate. This is the rate of return that they need to have. This is, as Matthew said, quick, simple model, annual in arrears. And we can see that the net present value at 125 is positive. So that would suggest that it's viable. But that the internal rate of return is showing at 6.4, which again is above the hurdle rate. Then we could get into stress testing, probability, applying weightings. If we apply the weightings on probabilities of, it's just testing the exit yield, whether that might shift over the 10 years holding period. We're kind of, with the subjective weightings we're adopting there, we could end up with 5.8. Which is still just marginally above the hurdle rate. So again, it would imply that for the individual investors' take on this, the 125 is conceivably viable. So that's just the investment value or investment worth approach. Then a very simple kind of separate approach. It's again similar figures, but we're saying instead of a hurdle rate, it's a discount rate, and we're getting an MPV. There's some variation here because of how the model has changed, but essentially it's the key difference I would note, apart from a degree of rounding, is that the initial purchase price figures aren't factored in there. So this